In November 2022, this article was released. 60% of Americans are living paycheck to paycheck heading into the peak shopping season. This was November 2022, so about almost a year ago. On August 31st, 2023, 63% of Americans are unable to pay $500 emergency expense survey finds. Now, this is something that I see often when I read these articles, and I see a lot of information on people living paycheck to paycheck and how, people are struggling in general. And I have to be honest, everyone feels it. Even the rich are feeling it, even the poor are feeling it, everyone is feeling it. But there's a reason for that. A big part of that is because, we know that inflation is so high, interest rates is still going up. We have to deal with the fact that things are getting just more expensive. Now, when it comes to being able to afford things, however, we have a choice. And that choice is choosing what we spend our money on. Now, there are basic things that we need, and those are, transportation, shelter, food, and of course, take care of your health. But when it comes to those first three that I mentioned, those are the three that we generally do not have much control. When I say much control, I mean, if things are getting more expensive, well, it would affect everyone. Now, there are some areas that will be more expensive than the others, but the point here is you cannot always dictate what you would spend on gas, right? Because gas prices will always change. You can always dictate what you would spend exactly on food because food prices will always change. But what we have control over is the amount that we choose to put on those things, okay? For example, if you choose to eat out, well, that is a choice. You can always opt to buy food and make your own food and save some money in that way. When it comes to where you live, well, if you live in a big house that is expensive to afford, but maybe you can choose to downsize. If you live in an expensive area, maybe you can choose to move. It all depends. Everyone's situation is different, so I'm not going to make, a claim for everyone. But the point here is 63% of Americans are unable to pay $500 emergency expense. Why is that? Why do you think that is going on? If you have a job and you're working, yes, things might be expensive, but there's one simple rule that you can create. And I'm going to use our taxes as an example. If you think about taxes, there's a reason if you are a W-2 earner, right, where you work and you're employed by someone, your taxes are usually taken out before the money comes into your account. There's a reason for that. The government knows that if they gave you all your money without taking out taxes and expect you to come and pay them the taxes that you owe, well, they know that they won't have any money. So the trick, or they make it a point that every paycheck, a certain percentage is taken out. Whether your situation changes, whether you have kids or you don't have kids, whether you get married or you don't get married, whether things go on in your family, in your life throughout that course of the year. And at the end of the year, you file what they call the taxes, right? Where you file taxes, and then if you pay too much in taxes, they give you some back. If you did not pay enough, then maybe you owe something, and they give you a deadline to make those payments. But hear me out. If the government is doing that to our paychecks that we've worked hard for, why can't we be disciplined enough to make sure that we can actually take out something for ourselves in case of emergencies? Now, if you read this article, which I'm going to link below, you would see that a lot of people often go to credit cards, loans for their emergencies, which isn't something that you want to do because that also comes at a price. So for that emergency that is only going to cost you, let's say $500, well, now you end up with an interest on that. Maybe it's 10%, maybe it's 20%. You end up paying, let's say, $550 back to this loan of $500, which means your earned income is further going out to banks and people that loaned you the money. And that's not what you want to do. What you can do is to automate your savings. Let a certain percentage of your earned income go out to your savings account. If you automate this process, you don't have to think about it. Just like how the taxes are taken out from your paycheck. So let's assume that you get paid $1,000 at the end of 2 weeks, right? You can automate maybe 10% of that to go to a dedicated savings account, preferably high yield savings account, where the money can at least earn something decent and keep up with some form of inflation, which we know that inflation is quite high. It's going down. We hope that it continues to go down, but there is a price, remember, for the fact that interest rates is so high also, because if interest rates are high, businesses are having to borrow money at an expensive rate, which means that whatever they produce, whether it's food, whether it's equipment, whether it's cars, those things will also become more expensive to buy. And it's a double-edged sword, because even though inflation is going down, the government is having to increase interest rates. By increasing interest rates, it means that we as consumers are still paying a price for the fact that even though inflation is going down, we're still having to pay a price for that increase in interest rate, whether it's through consumer loans, whether it's through school loans, whether it's through mortgage loans, all of that. And businesses are having to pay the price as well. Even though the idea is to bring down prices, but if you're increasing the cost of borrowing money, well, there is a fine line between when a company is making money based on the amount that they borrow and the rate at which they borrow that money to produce. So they need to also make some returns on that money. And that's why, the system can sometimes get to a point where it just collapses, because whatever they do doesn't fix the problem entirely. But somehow we're making a headway. So let's hope that we can get to that point where inflation gets back to about 2%, that they hope. But my fear is that prices may not go down, because if interest rates is high, the cost of borrowing is high. And if cost of borrowing is high, businesses will have to make up for it somehow by increasing prices. Yes, inflation is down and the system is more controlled, but prices may not go down. And that is where we then need to adjust what we spend money on and adjust how much we borrow, because at the end of the day, if we don't have more than 12 hours to work in a day, assuming we are working 12 hours, well, there's nothing more you can do other than to increase your rate if you can. And if you don't have a choice to increase your pay rate, then the other thing you can do is to control your expenses. And hopefully you limit your borrowing cost by not using credit cards or expensive loans for emergencies, which if you just prioritize, say 10% of your income to go towards saving, you may have some money to cover that emergency. Let's assume that an emergency of $1,000 comes up. If you have $1,000, you're great. If you have $800, then that's better off than having to borrow a whole $1,000. And that is the point here. We can do better. Yes, things are expensive. Yes, we're all feeling the pain. That is the truth about it. But we have control on a few things. And that is our discipline to save. If we don't have any savings, we'd have to rely on things like credit cards, which can be very expensive and it costs way more than just what it would have cost us initially if we were proactive in the process. And I hope that this makes sense. If you're new here, by the way, my name is Steven. If you haven't subscribed, please consider subscribing. I try to make videos every twice a week. That's the goal. Sometimes I get busy because this is my full-time job, but I would love to see you in the next one.